So what is the mortgage pre-approval process even like? What are the steps? And I'm gonna break that down in this video. So if you're a first-time home buyer and you have no idea what to expect in the mortgage pre-approval process, you're in the right place. Now, if you do a quick Google search or look at other YouTube videos, you'll probably hear people talk about the first thing to do is to contact a loan officer or a mortgage professional as the first step. And I totally agree with this, and here's why. Before even contacting a loan officer, you can do a self-analysis to see if you're even ready to take that step. So you may ask, how do I do a self-analysis? Well, I'm going to tell you. So the number one thing you want to do on your end before talking to anyone is to check your credit score. What is your credit score? And there's a bunch of companies out there that will show you your credit score, and I'll leave one or two in the description below. But most banking apps or websites will give you some idea of your score. For me personally, my Wells Fargo and Capital One accounts both give me a glimpse into my credit score. And you want at least a 600 credit score to get an FHA loan and at least a 700 credit score to get a conventional loan. And that is the absolute first step. And if you're below those numbers, don't even waste anyone's time. You need to work on your credit. So the second most important thing to do a self-analysis is to check to see if you have a down payment, right? So do you have at least 5% as a down payment to buy a home or a condo? So if you know that homes in your area are going for $500,000, do you have at least $25,000, which is 5% as a down payment? And in addition to that, you'll probably also need an additional 1 to 2% for closing costs. If you do go the FHA route, you only need 3.5% as a down payment, but you still need an additional 1 to 2% for closing costs. So that gives you a total of 5.5% as a down payment for FHA and 7% as a down payment for a conventional loan. So if you don't have that, again, work on saving that money up. And the third most important thing is, do you have consistent income? That's pretty self-explanatory, so I'm not going to go into too much detail about that. So if you answered yes to all three of those questions, credit score, down payment, consistent income, then you're ready to take the next step, talk to a loan officer or mortgage professional to get the process started. And the next thing you might wonder is what documents are needed in the pre-approval process. So that's the other thing that you want to be aware of. You want to gather the correct documents so you can make the process simple. And this part is pretty easy. So you're going to need your last 2 months of bank statements to show that you have the down payment. So that's pretty easy. Log into your banking website, download your last 2 bank statements. If you're a wage earner or a W-2 employee, you're going to need your last 2 pay stubs. And again, most employers have a portal where you can just log in and download your pay stubs. So bank statements, pay stub. Also, if you're a W-2 employee, we're also going to need to see your last 2 years of W-2s and your last 2 years of tax returns. Now, if you're a business owner, we're not going to need pay stubs, but we will need to see your last 2 years of tax returns. Let's say you own a corporation, we'll also need to see your company K-1s. Now, these are some of the documents you might have trouble with, so you probably want to contact your tax preparer or CPA, and they should have a copy of your tax returns for your personal and your business. Now, this is what you'll need for a conventional loan. But if you're doing an unconventional loan, let's say you are a business owner with little income reported on your tax returns, an alternative route we can take is a bank statement loan. And with a bank statement loan, the lender uses your bank statement deposits as your income. And in this case, we don't need your tax returns at all. We will just need your last 12 months of personal or business bank statements to prove your income. Now, let's say you're not a first-time home buyer and you already own a property and you're looking to buy a second property or an investment property. In that case, we'll also need to see your mortgage statement and homeowner's insurance and rental agreement on your other properties. The thing we talked about earlier in the video was checking your credit, right? Your credit score. The role of your credit score has a huge impact on how much you qualify or if you even qualify or not. So something you should be doing 6 months, 1 year, or even 2 years in advance before even buying a home is checking your credit and keeping an eye on it. And of course, you want to make payments on time. You don't want to be late, because that's not a good sign that the lender should give you a mortgage. If you can't even make your credit card payments on time, how is the bank going to trust you to pay your mortgage on time? Ideally, another tip is you want to keep your credit card balances under 30%. So what that means is, let's say you have a credit card that has a $1,000 limit. 30% of that is $300. So you want to keep all of your credit cards under 30% of the available balance. And if you can keep them at zero or pay them off every month, even better. Now, another aspect of your credit that sometimes is overlooked, and I see this all the time, people don't like credit cards. And I totally get that. I don't want to have debt either, and I know you don't either. And you don't want to have a bunch of credit cards. But some people avoid opening up credit cards altogether, and that's actually going to hurt you when it comes to buying a house. Let me explain. Let's say you have 0 credit cards, or just 1 credit card with a small limit on it. Having 0 credit cards, or just 1, means you probably don't have a lot of credit history. So that's going to work against you when you're trying to buy a house. Or let's say you have, again, 1 credit card with only a $500 limit. In essence, I understand where you're coming from. You don't want to rack up credit card debt. And I agree with that. I don't want you to go into debt, but you want to open at least 3 credit cards and have some kind of activity on them every single month. Now, I'm not saying to rack up debt, but you can use your credit card and pay it off at the end of the month and not pay any interest. So there are people who completely avoid credit cards, and if you want to buy a house, it's going to hurt your chances, because your credit score can only go so high if you only have 1 credit card. So the secret number is 3. 3 open and active cards. So you may have great income, a big down payment, and that's all good. But if you have a low credit score, you're going to get a shitty interest rate. That's the truth, and we don't want that. So my suggestion is open 3 credit cards that have no annual fees. Keep them open, keep them active, but pay them off every month. Having a low credit score versus a high credit score is going to be the difference in you paying hundreds of thousands of dollars in interest over the life of a loan. So I've had this happen so many times. I have people tell me, Roger, I hate credit cards. I never use them. I avoid them altogether. And again, this is going to hurt you in the long run if you don't have 3 open and active credit cards. And just to be clear, it doesn't have to be just a credit card. A car loan is considered an active account. Student loans that you're making payments on count as an open and active account. Now, when it comes to student loans, if you have a student loan that's deferred and you're not making payments, that's not considered an open and active account because you're not actively making payments on it. So now let's say you have all of these things in order. How does the lender evaluate your eligibility? How does the lender know if you qualify? So let's give a quick rundown. So like we talked about earlier, your credit score is number 1. Do you have a 600 score for FHA or 700 for a conventional loan? If you do, you pass the first test in your eligibility. Number 2, do you have the down payment required? The banks want to see your down payment of 3.5% for FHA and 5% for conventional sitting in your bank account for at least the last 2 months. Now, let's say you deposit that 5%, the 25 grand we talked about, in your bank account in cash today, and then tomorrow you go and you want to get a loan, you're not going to qualify. And here's why. The bank wants to see that money in your bank account for at least 2 months. They call it seasoning. Just like how you season your steak or your chicken, they want your cash to be seasoned for at least 2 months. So we want that cash marinating in your bank account for at least 2 months. If you have that, then you pass the second piece of eligibility. The last thing they're going to evaluate is your debt to income ratio. By the way, if you have any questions on debt to income ratio, check out my last video where I break it down, and I'm going to put the link right here. and I go into more detail on how the debt to income ratios work and how to know how much you qualify for. So if you're getting a conventional loan, the banks want you to have a maximum of a 50% debt to income ratio. The best way to describe this is to take all of your debt, including your new mortgage payment. That number cannot be more than 50% of your total income. So again, check out my latest video and we go into detail about this. But just to give you a quick example here, if you make $10,000 a month, your total debt cannot be more than $5,000 a month, including that new mortgage. FHA loans, they're going to allow you to go up to 55 to 57% debt to income ratio. So they have a little bit more flexibility on the FHA loans if you have more debt. So if you meet all of these criteria, the bank will likely approve your loan. Of course, there are nuances, but this gives you a general idea of how the pre-approval process looks. So number one, do a self-analysis. Number two, gather your documents. Number three, keep an eye on your credit score. And number four, if you've done all of the above, then you can start the conversation with a loan officer or mortgage professional. So that's it, guys. Thank you so much for watching. If you found any value or if you have any questions about the pre-approval process, if anything in here did not make sense or if you have any other questions, please leave them in the comments below. Thank you so much for watching and I'll catch you on the next one.